Robert Dan Roses. Cathy Yang, your intel on the Philippine markets and the economy. In the headlines, the Bangko Sentral ng Pilipinas cuts the key policy rate by 25 basis points as expected, taking it to its lowest in 3.5 years. Bangko Sentral Governor Eli Remolona joins us live from Manila. And for immediate reaction, Group economist Robert Dan Roses of SM Investments Corporation is standing by. We'll speak to him right after. Finance Secretary Frederick Go says the government could lose about 8 billion pesos yearly if the travel tax is removed. And Executive Secretary Ralph Recto promises to fast-track decision-making and regulatory certainty to encourage more Japanese investments. The Bangko Sentral ng Pilipinas has cut key interest rates by 25 basis points at its first policy meeting of the year. The benchmark rate now stands at 4.25%, the lowest in over 3 years. Rates on overnight deposit and lending facilities were also trimmed by 25 basis points each to 3.75 and 4.75% respectively. This brings the Bangko Central's total reductions to 225 basis points since it began easing in August 2024. The decision met market expectations as all 16 analysts polled by Business World anticipated a 25 basis point cut. It also came amid weaker than forecast domestic growth, with softened demand weighing on the economy.
We are reassured that inflation expectations remain well anchored. Growth has been softer than expected. Investment slowed. We attribute this to a lack of confidence. But soft data on sentiment show tentative signs of recovery.
And with us now for more is Governor Eli Remolona of the Bangko Sentral ng Pilipinas. It's good having you back on. Governor Eli, welcome to the program.
Thank you. Good morning, Cathy.
Good morning. So was 25 basis points of a cut a unanimous decision by the Monetary Board?
I'm not at liberty to tell you, but there was I would say there was a large consensus.
Large consensus. So for those who countered, Governor, did anyone favor hold?
I can't tell you, but it was a lively discussion, Cathy.
A lively discussion because, well, we have Secretary Go, who first sat in for the first time.
Yes.
It's his first policy meeting, so that's a representation of whatever the fiscal side is planning to do. What were the lively discussions like when it just does not border on monetary policy but encompasses the fiscal side?
Yeah, so it was lively partly because, as you know, our mandate is low inflation. And so the discussion was, can we still do something about growth while still focusing on inflation? That's where the discussion came from.
So can we do something more about growth, given the bigger output gap that you're now seeing? And this is something that you made a big deal of in the media briefing yesterday. How close or far is the BSP to neutral interest rate?
Well, we now focus on the output gap. We're about 2% below potential. So that gives us a lot of room to ease without causing higher inflation.
Well, I'm just trying to connect the dots here because December, you did say that we're coming to
Yes,
the
yes,
end of the easing cycle, and now you're saying there's a lot more space for easing
yes,
given the
yes.
output gap.
Yeah, in December, during the policy meeting, we did we did think there was a chance that we would ease again. As it turns out, as you know, we did ease yesterday, but this time we're looking at a horizon in which there's an extra element of uncertainty. And the uncertainty, of course, comes from the fact that growth was much lower than expected in the fourth quarter of 2025.
All right. Well,
And
you
so,
mentioned in that media briefing the 25 basis point cut may help restore confidence. And
yes,
confidence
yes,
was a repetitive word all throughout those 40 minutes,
yes,
boosting investment, consumer spending. So,
yes.
Governor, what do we need to see to be forewarned that this confidence shock is becoming a deeper demand problem?
Well, it has been a deep demand problem, but you know that confidence and growth are a two-way street. Confidence affects growth, but growth also affects confidence. So we were trying to do something on the growth side in an effort to bring some confidence back, and we hope that works. We don't really know when confidence will come back. We think it will take a few more months when it comes back, when it will come back in strength. But we don't really know that. Our models say it will come back soon, but that's just our models.
Yeah, and it's really human intervention that's most
Yes.
important and analysis. So, what do you think would break that cycle?
Well, I think, as we've said in the past, we need credible reforms, evidence of credible reforms. At the same time, we need a little bit more growth. Because if you're trying to invest, why would you invest if growth is not going up? So we need both. We need growth and we need confidence.
Exactly a two-way street. So if confidence fails to return as fast as you expect, do we read that as a case for doing more cuts? Or would you say at some point monetary policy is done enough and this is now for fiscal and governance reforms to fix?
Yeah, as you suggest, we have very limited tools in monetary policy. Basically, we have tools on the demand side, and we are supposed to focus on inflation. So it's not clear how much more we can do. We're looking at the numbers. We'll collect more data and then decide what can we do that will be helpful without sacrificing our mandate about inflation.
Yeah, the numbers speak loads. When you look at GDP falling below the government's earlier target, led by
Yes.
declines in public
Yes.
infrastructure spend, private construction, because of the corruption fallout. So, how much still
Yes.
can monetary policy realistically counter what is in large part a fiscal and confidence shock?
Monetary policy can do a little bit, and that little bit is what we're trying to do.
Well, do you worry that too much focus is now being placed on interest rates as the solution when the bigger constraints may be project execution, governance concerns, and external headwinds like tariffs and geopolitics?
Yes, that is a concern. Yeah, it's inflation. Interest rates can't do the trick. It needs help from other things.
And those other things come from the fiscal side. Did make a mention that this is the first monetary board decision in which the finance secretary, Frederico, sat as a voting member. How
Yes,
closely
yes.
are you coordinating with the economic team on the 2026 budget rollout and infrastructure pipeline so that your policy stance is complemented rather than offset by the timing and the quality of public spending?
I think Dec Go, I call him Dec Go, was very helpful during the policy meeting, and I think he will continue to be helpful. So I welcome his presence on the monetary board.
What were the key items or maybe insights that formed the opinion of a 25 basis point cut from the good finance secretary?
Oh, it was a lively discussion. I'm not. He of course talked about the fiscal side, and he of course expressed his view about what we should do with the policy rate. But it was a back and forth discussion. It was very friendly, very, and I would say somewhat academic. A lot of numbers, a lot of graphs, the usual stuff, Cathy.
Indeed, which is why you came up with the word nerdy in the media briefing. But Governor, if fiscal support disappoints or is further delayed, would that argue for doing more on the monetary side? Or are you reaching the point where additional rate moves would bring more risks than benefits?
We feel that we're at the point where monetary policy cannot do much more. But as I said, things are very uncertain. We have to crunch the numbers some more. We have to look at more data, and then we'll see.
All right, well, let's get to the risks here, Governor. Does the BSP see any evidence of systemic capital flight linked to the flood control corruption scandal?
We see nothing systemic so far. We, of course, are watching that very closely. We have a group that focuses on systemic risk and focuses what's going on with the banks. And so far, so good. The banks remain healthy. They're well capitalized. They have plenty of liquidity. Our foreign exchange reserves are ample. So on the systemic risk side, we're in good shape.
All right, we got about 2 minutes here. I wanted to ask you about our ASEAN chairship this year. That's been one of the topics in the media briefing. One of your 3 initiatives is really making it seamless for digital payments for everybody.
Yes.
What trends are you seeing right now when it comes to digital payments in the Philippines, especially with what you've seen in 2025?
Well, digitalization continues. It's a good thing. At the same time, it brings with it some risks. We worry a lot about cyber risks. So even as we encourage digitalization, we're also trying to get the banks to also make sure that they defend themselves against cyber risk.
Are we still on track to reach the 70% target for digital payments by 2028? Because that is the stated goal in the Philippine Development Plan.
To be honest, Cathy, it's been slow. We're on track, but maybe it will take a couple more years than we thought to get where we want to go.
Beyond 2028, Governor.
Yeah, I think so.
All right. It was about the same month last year, Gov, if you remember when you told us on this program to keep an eye out on the Financial Action Task Force report, because the Philippines is highly likely to come off that gray list, and come off we did. Didn't we? In fact, the Philippines marks its first year off that gray list tomorrow, February 21st. But what are the chances now that we'd be back on that list because of the flood control corruption scandal?
I have to admit there's some risk, but we're doing all we can, and I think they tend to appreciate what we're doing. We're doing all we can with money laundering, for example. We're tracking money flows very carefully, and they see that. So I think we won't go back on the list, but of course there is a risk.
All right, that's enough assurance for us. Governor, I'd let you go. Thank you so much, and keep us up to speed on that confident shock. Governor Eli Remolona of the Bangko Sentral ng Pilipinas. Well, Finance Secretary Frederico estimates a foregone revenue of 8 billion pesos every year if Congress scraps the travel tax. On Wednesday, Go said the Finance Department is deferring to Congress whether to abolish the travel tax or not. Total revenues from the levy amount to 8 billion pesos annually, half of which go to the Tourism Infrastructure and Enterprise Zone Authority, 40% to the Commission on Higher Education, and 10% to the National Commission for Culture and the Arts. President Marcos has included the travel tax abolition to his 21 priority legislation this year, and his son, House Majority Leader Sandro Marcos, already filed a bill scrapping the charge. The Foundation for Economic Freedom notes there are more Filipinos traveling abroad than foreigners exploring the Philippines. The Federation of Philippine Industry says scrapping the travel tax is long overdue and will encourage more travel. Meantime, the DOF will review the Organization for Economic Cooperation and Development suggestion to remove VAT exemptions for senior citizens, private schools, and healthcare providers. Go said, while OECD's suggestions are good, the Finance Department needs to study which of them are feasible. Executive Secretary Ralph Recto says the government is ready for more business opportunities with Japan. Recto called Japan one of the country's most reliable partners, citing its long-standing role in infrastructure and disaster response. Speaking ahead of the 42nd Philippines-Japan Economic Cooperation meeting, the Executive Secretary said the government is committed to faster decision-making and more predictable rules. What investor wants, he said, is fairness, clarity, and speed. Japan remains a top trading partner and source of official development assistance, backing major projects like the Metro Manila subway. Recto also said trade flows are robust but still have room to grow, including in services and tourism. He told Japanese executives the government is working to make doing business in the Philippines easier, faster, and more reliable, adding that the success of Japanese investments is also a win for Filipinos. The Philippine Economic Zone Authority is expecting more investments from European firms once the country finalizes its free trade agreement with the European Union. PEZA says the deal could boost jobs, exports, and economic growth while strengthening the country's position as an investment hub. With the current trade perks set to expire in 2027, both sides are aiming to conclude FTA negotiations, with officials projecting up to $12 billion in additional Philippine exports. European officials, meanwhile, say talks are also focused on ensuring policy stability, regulatory transparency, and fair competition. You're watching Money Talks. Coming up, the country's balance of payment deficit sharply narrows in January. And the Philippine peso retreats Thursday, ending a 5-day rally following a rate cut by the BSP. Keep it here on One News. Welcome back to Money Talks. I'm Cathy Yang. The country's balance of payments deficit narrows to $373 million in January. Data from the Bangko Sentral showed a sharp improvement from the more than $4 billion gap a year ago. It is likewise smaller than December's $827 million deficit. January marked the third straight month of a deficit. SM Investments Corporation Group economist Robert Dan Roses told Business World the gap reflected seasonally strong import payments and profit remittances at the start of the year, along with portfolio adjustments amid global rate uncertainty. Jonathan Ravelas of Reyes Tacandong and Company meanwhile cited the country's persistent trade gap driven by strong domestic demand and infrastructure spending. He stressed, however, that it is not a crisis signal as the Philippines' external buffers remain solid. Checking in on the markets, U.S. stocks slipped Thursday as investors await a new batch of corporate earnings and geopolitical developments driving up oil prices. The Dow declines by 0.5%. The Nasdaq fell by 1/3%, and the S&P 500 shed by over 0.25%. The 10-year Treasury yields ticked down to 4.074%. Gold prices settled to $4,975 per ounce. As for U.S. futures, they're pointing to slight gains when the markets open later tonight Manila time. S&P 500 and the Nasdaq both up 0.2% each, and the Dow rises by about 0.1%. Asian markets, a mixed bag this Friday, with most indexes tracking Wall Street's losses. South Korea's Kospi is up by over 1.1%, and Japan's Nikkei 225 tumbles by over 1.1%. Australia's ASX 200 slides about 0.1%. And a quick check on our own markets in this final trading day of the week. PSEI opens this Friday near the flat line, 6,406. The stock market advanced by nearly 0.2% yesterday following the latest rate cut from the Bangko Sentral. The broader all-shares index climbed by 0.1%, with the sectoral gauges mostly in the green. As for the Philippine peso, it opens today a tad weaker, 58.051 to the dollar. Peso ended its 5-day rally yesterday to settle at 57.996 to the dollar after the Fed sent hawkish signals and the BSP delivered its 6th straight cut. And the 10-year government bond yields ticked up to 5.968%. And joining us this morning is Robert Dan Roses, Group Economist at SM Investments Corporation. Good seeing you again. Dan, welcome back to the program.
Thank you, Cathy. Thanks for having us.
Okay, so you shared the stage with Governor Eli last February 11th at the MAP Forum, and you were a reactor in there. You've just heard it moments ago in my conversation. How are you assessing the nuanced shifts, if any, in his messaging, given that the Monetary Board worked on a recalibrated model in this round in determining the confidence or the lack thereof?
Yeah, that's a very good question. I observed three things. Now, let me give you key takeaways from that statement. The first one is measured easing. So they cut 25 bips to 4.25%. That's actually supportive, but not too aggressive. The second one, it's a repeating theme. Inflation is under control. So supply-driven uptick, or despite the supply-driven uptick, there's expectations that have been anchored, and that's very important. So we are still on track for a 3% inflation band, probably by 2027. So this year and next year, we think that inflation will still remain within the target band. And that's important because that actually drives the decision of the BSP. The third one is actually growth, which needs a boost. So the investments from last year's load on weak confidence, the rate cut actually aims to help restore it. And if I can add to that quote-unquote nerdy conversation or nerdy impulse, it's actually what we're seeing right now is exogenous to the BSP, meaning it's outside, it's beyond their control. And there's only so much that monetary policy can do. And you're right to point out now that the fiscal side should be able to complement it. And talking about the output gap and the uncertainty, which both of you mentioned earlier, I think BSPs will actually be on a data-dependent path. So there's no preset course for the BSP. They will likely respond to evolving conditions, and that was made clear by the statements of the governor.
Yeah, and those evolving conditions really anchored on that confidence shock that he made a mention of repetitively in the media briefing, and that bigger output gap, Dan. From the perspective of corporate, what are you seeing in terms of investment and spending in the transmission of the rate cuts and what he's been doing, and also the messaging on investment and spending?
Okay, if we put a metric on how the previous rate cuts, I'm not talking about the recent one. You had 200 basis points cuts already, 225 if you include yesterday. So the monetary policy transmission actually takes some time. I think the observations are correct. It might take 6 months to a full year for the full transmission of it. No? And given that, we are confident that the second half of the year will most likely be a recovery period. No? So that's why a lot are projecting that GDP growth for 2026 will be much better compared to last year. No? So the transmission takes some time, but if we measure it by how successful inflation has gone down, I would say that it has worked. No? But it took some time. So the future moves actually depend on incoming data, inflation price. I guess for businesses like us, those same metrics will also be very important to observe, no, or to anticipate in the coming months.
Right, which makes it so interesting, Dan, if we are projecting a second half recovery across SM's businesses. You've got retail, property, banking. Where are you already seeing the benefits of lower rates? And where does the economy still feel stuck in a wait and see?
Well, I think it's mostly, same thing as what the central bank is seeing. It's still confidence. No? Fourth quarter, we saw the GDP data already. We saw household consumption, which forms a big part of our businesses. It was flat. So given that it was a consumption quarter, that tells us something very big, no? Which means that confidence is actually how do you say this? Confidence is actually flat as well. So it's wait and see mode, but like what I told the audience where the BSP Gov and I were in, the fundamentals are intact. If you take a look at the measures of growth, they are intact. So what we have actually is an execution problem. It's a confidence problem. It's not an execution problem. So that was exacerbated by the scandals that we saw last year.
We have about 30 seconds, given everything we've talked about, Dan. Rates, confidence, growth, ratings. What keeps you more awake? Is it that the BSP does too little and the recovery fizzles, or that it does too much and risks losing its inflation anchor?
Well, I sleep soundly knowing that the authorities are on top of it, especially the BSP. So I think what they did yesterday was measured. It was widely expected that they will be doing that, so it was priced in already. But like I said earlier, it's supportive but not aggressive. So at least we are doing those. The stepping stones are actually in place already. So that will help in restoring confidence.
And if it helps to know the governor's just listened to this conversation, Dan, I hope he sleeps soundly too, just like you. Thank you so much for joining us, for your insights. I much appreciate Robert Dan Roses of SM Investments Corporation. And before we go, here are some movies hitting Philippine cinemas soon. First up, Taiwan's top-grossing supernatural horror film Mudborn is coming on March 18th. The story follows a VR game developer who brings home a broken clay doll from a haunted house. His pregnant wife restores it, unleashing a string of terrifying events that force the family to seek help from a psychic exorcist. And on April 15th, Lee Cronin's The Mummy is arriving in theaters nationwide. A journalist's daughter who vanished in the desert returns home after 8 years later. But what should have been a reunion quickly turns into a nightmare.
Say something. Don't worry, Grandma. It's fun to be dead.
Oh my, I don't know about you, but I'm going to be sleeping soundly with that as I love horror flicks. That is it for Money Talks. I'm Cathy Yang. Catch us again on Monday at 9:30 a.m. Kapatid, we are one news, all sides, all the time. Have a great day ahead.